Esteemed chartered accountants and other members of the Institute of Chartered Accountants of India or non-chartered accountants who have joined us today for this webinar. It's a great feeling to be with you again. On your screens, you will see two individuals. The one is Mr. Stephen Dale, the other is Ms. Ruth Corkin. Esteemed friends, as all of you are aware, GST in India is now in its 8th year. The GST in India is no different from the VAT or the GST you call it in other countries. India is also a member and not a full-time member, but a member of the OECD's group. And India follows the OECD model as far as the consumption taxes, which is GST. And as all of you are aware, Europe is the birthplace of the VAT and the form in which it is being implemented now. Over 150 plus countries in the world have borrowed this OECD model and implementing the consumption taxes. Consumption taxes are the lifeline of any country. The finances of the country run because of consumption taxes, and consumption taxes are not static. They're dynamic in nature. They keep changing the manner in which the economy of the country goes up and down, economy of the nations goes up and down. And consumption taxes are also used as a political tool to win elections by the political bosses. So, esteemed friends, the procedural matters of GST in India are no different from what it is in the outside world, barring a few changes. India does have e-invoicing, India does have e-filings, and India is again fully networked as far as GST is concerned. We have today with us two very esteemed members from Europe and one from the UK, who are going to take us through on the concept of e-invoicing and e-reporting in the European Union. In the Indian context, we know what is e-invoicing. But what is this e-reporting? Is e-invoicing actually e-reporting in India, or is it something different? We have Stephen Dale. He has been the president of the International VAT Association for a few years, of which I am also a member. I've been having a great opportunity to interact with Stephen Dale many number of times. An intellectual, he is. He is also currently holding the chair of the VAT and the Indirect Taxes Committee of the ICAEW, which is equal to the GST and Indirect Taxes Committee chairman of ICAI. Stephen Dale is a chartered accountant, a person who brings in enormous years of experience, intellectual exposure that he has got in the field of consumption taxes. He lives in the famous city of Paris and he practices there. He actually works very closely with the European Union's Council, the EU VAT Council, and has represented many number of cases as far as the consumption taxes, which is VAT in the European Union. We also have Ruth Corkin, who is again a member of the International VAT Association, the board member of the International VAT Association, and a person who is very actively involved in the VAT implementation, in the VAT practice in her country. She is also a member of the ICAEW, Institute of Chartered Accountants of England and Wales, the VAT and the Indirect Taxes Committee. Both of them have agreed at my request to speak to us. Of course, time difference be noted. For Stephen Dale, it's morning 11:30 a.m. and for Ruth Corkin, it is 10:30 a.m. there, the London time. Friends, you know this is a working day today, and both of them are extremely busy professionals, and they are here with us. We welcome Stephen, we welcome Ruth, and sincerely express our gratitude for being with us, for accepting our invitation, and also for taking us through your presentations. I'm sincerely thankful again, Stephen, and thank you, Ruth Corkin. Now it's over to you. Stephen and Ruth.
Thank you, RK. Let me just share my other screen. Um, yeah, first of all, thanks for that fabulous introduction. Also, thank you for inviting us because it's a great honor for both myself and Ruth to have the opportunity to speak to your colleagues about what is going on in the European Union. And as you quite rightly point out, India, at least in terms of invoicing and many other areas as well, is in advance compared to where we are in the European Union. And I'll let Ruth talk about the UK and the UK's particular situation on e-invoicing later. But thank you again, RK, for the invitation. It is very, very much appreciated. Before we start going into the detail of the subject matter of our webinar, which is e-invoicing and e-reporting, we'll just kind of very quickly outline, where this part of the EU's developing VAT policy is actually lying. In other words, it's not just on its own, it's not a standalone subject, the e-invoicing, e-reporting. It's actually part of a much bigger package, which we call the VIDA package, VIDA, which stands for VAT in the Digital Age. In other words, what the European Commission is doing is bringing the European Union's VAT system, which, as RK pointed out, was introduced into the EEC as it was at that time in the 1960s. And it hasn't really evolved at the same rate, at the same pace as technology has evolved, as business has evolved in the last 60 years. So this is a major change which is taking place. And as I say, invoicing, e-reporting is just one part of that overall package. And we'll just spend a few minutes just looking at what the other parts of that overall package actually look like. On the VIDA, it's very recent legislation, so it's taken a long time to get adopted, get approved. As you probably know in the European Union, a bit like India, on tax issues, tax matters, all of the 27 EU member states have to agree unanimously to any modification, any change, any new legislation being introduced. And without all 27 member states agreeing, then no progress can be made on tax issues at an EU level. We'll try and also place where the EU's approach to e-invoicing is in relation to what is going on a global basis. RK mentioned that there's a lot of work going on at the OECD level, and we'll talk about that very briefly towards the end. I will also kind of just think about, what are the overall objectives of this VAT in Digital Age package, which was adopted in March and actually took effect in April earlier this year. Invoicing, Ruth will take us through in detail exactly what that entails at an EU level, and the real-time digital reporting, because that is something which is separate, obviously linked to, but it's separate from invoicing. We'll explain in detail, what the different scenarios are where you will have perhaps e-invoicing, not digital reporting, and opposite way around, digital reporting without e-invoicing, and in some occasions, perhaps both. We'll have a look at 2 EU member states. The 2 examples are France and Ireland, because in addition to what the European Union is doing, the EU member states on their own now have the possibility, that's only fairly recently had the possibility to do it, but now have the possibility to introduce their own e-invoicing, e-reporting systems without having to obtain any form of agreement from the European Commission and the European Council, which was previously the case. And as mentioned, we'll have say a few words rather, about the OECD and their project on digital continuous transaction reporting. So, as I mentioned, the e-invoicing, e-reporting is just one part of this overall VIDA package. The first pillar, one we're going to look at in detail today, is around e-invoicing, e-reporting, which we call Pillar 1. The second pillar is the introduction of a platform regime, or rather what's called a deemed supplier regime, for platforms involved in the provision of short-term rental accommodation. So we can think of Airbnb being impacted by this change. And also this change will impact the providers of passenger transport by road. So the taxi hire companies such as Uber, Bolt, and so forth, they'll be concerned by this. The idea being is that rather than the tax authorities having to collect any tax, any VAT that's due from each individual provider of the individual services, so with the provision of the accommodation, whether it's the provision of short-term passenger or whether it's passenger transport, the tax authorities will be able to collect the tax from the platforms providing these services through their platforms. Obviously makes collection easier, puts the responsibility on the platforms to make sure that they collect the right amount of tax, and also puts responsibility onto the underlying suppliers, so the taxi companies, the people who actually own the properties which are being provided for short-term rental. So there's a whole new infrastructure that's been put into place to enable the tax authorities at EU level to be able to collect tax from a more limited number of people, essentially the platforms, rather than the tax authorities having to collect the tax from each individual provider of the actual underlying service. Now, that's going to be quite a big challenge, quite a big challenge both for business and administration to implement that within the timeframes. We'll look at the timeframes in a second. And the last pillar around this is the what's called the extension of a system, a regime that already exists within the EU, which is to have one single place of VAT registration for businesses operating within one member state or within multiple member states, both in relation to supplies of goods and or services. So again, the objective here is for the administrations in one country to be able to control the activities of the business registered in their member state, even if the tax, the VAT, is in fact due on transactions carried out in other of the 27 EU member states. So I mentioned the legislation was adopted formally by the EU Council Ministers on the 11th of March. It was published in the official journal on the 25th of March and took effect 20 days later on the 14th of April 2025. So the legislation is in place, but what is not happening all at the same time is the implementation of each one of these three pillars. As I mentioned, some parts of this directive took effect more or less immediately when the directive took effect, so 14th of April. But most of the directive will only be progressively introduced or will only progressively take effect over the next 5 and up to 10 years. So one of part of the directive we'll mention later on provides that there will be some further changes potentially towards the, well, in 2035, so 10 years down the line. This is very, very high level time frame produced by the European Commission just to help understanding, if you like, as to exactly where we are on this timeline. So I mentioned that there was some bits of legislation immediately took effect when the directive entered into force on the 14th of April. Some parts of the changes were to increase controls around some of the existing tax regimes in place for the collection of VAT in the EU. In particular, to try and deal with some aspects of VAT fraud, which is unfortunately increasing in the EU at the current stage. There'll be some more relatively minor changes will take effect rather on the 1st of January 2027. Again, mostly relating to the VAT collection mechanisms called the one-stop shops, whether in relation to transactions within the EU or transactions between third countries and the European Union. So it's called the import one-stop shop, the IOSS. More changes, essentially the ones I described earlier in relation to the platforms having to collect the VAT due on provision of short-term rental accommodation, passenger transport by road. That will essentially take effect on the 1st of July 2028. Member states will, though, have the possibility to extend the introduction date or to push the introduction date back until the 1st of January 2030. And again, there's further changes to the VAT collection mechanism at one-stop shop. And we'll also look in an example later on about what happens when a business not established or not present, not even registered for VAT in a country in which the transaction takes place, can potentially avoid having to register VAT and account for VAT in that country under certain circumstances. And we'll look at that case in a bit more detail later on. Most of what we're looking at today, though, so the e-invoice and the digital reporting obligations will enter into effect on the 1st of July 2030. Now that's, somewhere away. It's 4.5 years away. But in fact, in terms of time frame, it's actually very short. Both business and tax administrations will have to be ready such that by that date, by the 1st of July 2030, e-invoicing, e-reporting will be introduced, will take effect, and will operate smoothly, hopefully, with effect from that date of the 1st of July 2030. And the date of 1st of January 2035, I mentioned earlier, this is 10 years away, is essentially saying that because, as at today, EU member states can introduce their own e-invoicing, their own e-reporting systems, which essentially, not exclusively, but essentially only relates to transactions carried out within that member state. The requirement set down in the directive is that member states will have to agree to align their national e-invoicing, their national e-reporting systems onto the EU's e-invoicing, e-reporting system, and that by no later than the 1st of January 2035. Now, for those member states, EU member states that have had e-invoice for some time, we can think of Italy, we can think of Spain, the actual change that may have to be undertaken for them is going to be much more difficult than for those member states more recently introducing their own e-invoicing, e-reporting systems, because those member states have taken into account the kind of the constraints, if I can use that expression, of the EU e-invoicing, e-reporting system, consequence of which those domestic e-invoicing, e-reporting systems will be able to converge towards the EU e-invoicing, e-reporting system much more easily by the date of 2035. So what are the overall objectives of the VIDA package? Again, it's not just pillar one, this is all the three pillars together. So pillar one, e-invoicing, e-reporting; pillar two, the platform acting as tax collectors for VAT due on short-term rental accommodation and passenger transport by road; and pillar three being the further extension of the single place of VAT registration. And the reason that the Commission is pushing, or did push very hard for these changes to be adopted, and this directive to be adopted, was that in the recent study that was undertaken, there was around 89 billion euros of VAT revenue at EU-wide level that were lost, not accounted for, and of which, in that 89 billion euros, there's somewhere between 40 and 60 billion euros, which was VAT lost in trade between the EU member states. So cross-border trade is the trade within the EU, but between EU member states. Those are huge numbers. There is a study which has just been completed, which will be based on 2023 numbers. And from the indications we've had so far, we understand that estimated VAT lost VAT revenue number will increase again, but we're not quite sure exactly as to where it will go. But apparently the increase is in certain member states quite significant. So action is required, and this whole package, of the VIDA package, is aimed to tackling these big issues of VAT fraud, VAT non-compliance, this 89 billion euro VAT gap. Simplify administration for business, that's clearly an objective. And in fact, when we look at what Germany is doing, when Germany is introducing its own e-invoicing system with effect from, in part, next year, the main driver for Germany introducing e-invoicing is not to do with VAT fraud. but in fact to simplify administration of business, make the whole of the VAT compliance process far easier for business and for the tax administration, and thereby reduce costs on business, make business, German business, more competitive, both domestically and, of course, in the international marketplaces. The overall VETA package is expected to generate substantial economic benefits, again, not just for business, but also for the member states' administrations, of which the up to 214 billion euros of economic savings over the 10-year period. The Commission identified that there will be about 51 billion euros of savings arising for business. In other words, businesses' costs, administration, processing, compliance, their costs will go down by 51 billion euros, again, over that 10-year period. It's not just a one-off effect. The legislation that was adopted, finalised, took effect in April of this year, was proposed by the Commission in December 2022. So it was 2.25 years from the date it was proposed for that legislation to be actually adopted by the 27 member states. As I mentioned earlier, because the process requires, or the legislation requires, or the treaties require, that legislation on tax matters must be adopted by a unanimous vote of all 27 member states. The directive, as proposed by the Commission back in December 22, was unfortunately, I will say, in some respects, substantially modified compared to the original proposals. What we see in particular is that to get the all member states to agree to the final text, the Commission had to accept that there would be introduced in various parts of this legislation various options, various derogations, allowing member states to treat transactions in their particular way in their member state, which would not necessarily be the case across the other 26. So, consequence of which, unfortunately, rather than having a fairly tightly structured directive, having effect in more or less the same way in each and every one of the 27 EU member states, we are unfortunately going to find ourselves in a situation that businesses, in particular those businesses operating across border, in other words, in multiple EU member states, are still going to be confronted with a legislation which is actually a bit disparate in the sense that it's not consistent across each and every one of the EU member states. It is the biggest change to the EU's VAT system since 1993. EU has the VAT, or the EEC as it was at the time, has VATs, as I mentioned, since the 1960s. And as Arcade greatly pointed out, the EU VAT system has its origins in France when it was introduced in the French Parliament on the 9th of April 1954. So a long, long time ago. And as I mentioned earlier, unfortunately, by having a system in place for over nearly 60 years already at EU level, it means that the EU system is not adapted. It's not that well connected to the modern economy, and certainly currently does not include an awful lot of digitalization of the process and the procedures for complying with VAT across the EU member states. Legislation was adopted in essentially three separate pieces of legislation: in a directive, 225/516, in a council regulation, 225/517, and an implementing regulation, which essentially lays down the detailed rules as to how the directive itself is to be implemented by the member states. And what has happened, of course, is that that legislation was being of itself very substantial, very substantive. The legislation, the new legislation, effectively amends and updates the existing legislation, which itself over the years has grown. If we go right back to when the first, I will say, harmonizing directive at European level was adopted at the end of the 1970s, there were 28 articles and 9 annexes. And the directive, the 2006 directive, as amended by the new directive 2025/516, there are now over 400 articles 12 annexes, but in each of the articles, for example, the Article 369, which we'll talk about later, has something like 50 subsections in one article. So the whole of the EU's VAT system has become more complex, more detailed over the years. Whether that's a good thing, a bad thing, we can perhaps have a separate discussion on that on a separate occasion. So the timeline, again, just essentially setting out what we talked about earlier. It just a bit more visual, I think, in terms of what happens at what particular point in time. But it's a lot of work, and the Commission is conscious that there's a lot of work that needs to be undertaken between now and, let's say, 2030 for the implementation of Pillar 1. The Commission only has existing resources. The Commission will not increase its resources, not on a full-time basis, in order to do the implementation of all of these parts of the VIDA package. So as you can see, there's a substantial amount of work that's got to be taken, it's got to take place between now and, as I say, 2030, which is now what, in 4.5 years' time. The Commission, however, this is fairly recent, published what they call a strategy document. It's essentially a roadmap and sets out what all the member states, what the Commission has to do, what business has to do between now and the various timelines or dates in that timeline we've just seen. The Commission is trying to be as detailed, as granular as possible in that strategy document. But clearly that strategy document will evolve as time goes by, simply to take account of unforeseen circumstances, which of course the Commission couldn't take into, or was not able to take into account when the strategy document was developed. Also, what the Commission has done is actually identify what the various, in their view, the kind of substantial blocking points might be. So the Commission is saying to member states, these are what we have identified as potential blocking points, potential showstoppers. You member states, what are you going to do to make sure these showstoppers don't arise? What do you need to do to make sure that everything is smoothly introduced, such that by the time we get to the 2030 for Pillar 1, as I say, the whole system works smoothly and functions correctly, both for administrations in member states and business as well. So I'll talk a little bit about the digital reporting. It's going to involve businesses having to declare on a more or less real-time basis. And again, Ruth will take us through the detail. Transactions at this stage, which only relate to transactions cross-border within the EU. So whether it's e-reporting, whether it's e-invoicing, at this stage, this will probably change over time. At this stage, it only relates to transactions involving businesses established or VAT identified in more than one member state. So as I mentioned, the objective is to try and reduce VAT fraud by 11 billion a year, bring down administration costs of 4.1 billion. This is how we get up to nearly the 51 billion administrative cost savings for business. And the communication protocol of the e-invoicing, e-reporting between business, their tax administrations, the protocol that has been determined is the protocol EN 16931, which is actually laid down by the 2014 directive. And again, Ruth will talk a little bit more about that later on. That directive, though, that protocol and the directive, the 2014 directive, will change. The Commission announced only last month there is work ongoing to essentially update that protocol, update that European standard, and it's that whatever updated standard, whatever that updated protocol is, once adopted after these current discussions are finalised, that will be actually effective when we move to e-invoicing, e-reporting EU level in 2030. The Commission, in the part of their strategy document, have highlighted essentially, if you like, kind of three categories of member states, depending where they are in their own kind of evolution towards e-invoicing, e-reporting. and the Commission has already identified that the substantial challenges, potential kind of showstoppers, likely to impact the introduction of invoicing e-reporting, and mostly around member states' own reporting systems and their ability in the time frame that is very short to develop and implement the necessary IT infrastructure. And so the Commission essentially have done is to kind of break those member states down into three categories, say, who's now ready, who potentially is ready, who's got little or no experience of e-reporting, digital reporting systems. So the Commission therefore can focus its time, attention, efforts on those member states which need more support, so that everybody, because the system will only work, of course, if everybody, all 27 member states, are ready with effect from the first from 2030. There is some more law required. So despite the directive, council regulation and the implementing regulation, there is some further legislation going to have to be adopted before all of this can take effect. There are two pieces of legislation required to give effect to the Pillar 1, which is e-reporting and invoicing, are those two highlighted in yellow. Shouldn't be a problem. That legislation should get adopted. Essentially, all it is doing is saying, in order to make the system work, we've got to have the same rules that in each of the member states, which is why the legislative tool that's being used is an implementing regulation, which is directly binding, has direct effect on all 27 member states, without them requiring to make any changes. As RK mentioned, e-invoicing is not new. If you look on a global basis, and this is just a very kind of quick snapshot of what's going on at EU level, on global level, we can see that some countries introduced e-invoicing in the early 2000s. So the EU is clearly very far behind. We're now in 2025 for a few more days, and the EU's e-invoicing system will only then be introduced in another 5 years' time potentially. And as I mentioned, Ruth will say a few words about what the UK has recently announced in terms of its possibility or its thinking around invoicing and what that might look like. But enough from me. Let me hand over now to Ruth, who will take us through what this EU e-invoicing is in a bit more detail.
Thank you, Stephen. And I'll pick up on that point about the UK because it is brand shiny new in the UK. So in our fiscal event a couple of weeks ago, our Chancellor of the Exchequer announced that the UK will be introducing e-invoicing in 2029, so just before the EU. It will apply to all UK businesses, and they are going to develop a roadmap in the fiscal statement in 2026. So by the time that comes out, we will only have 3 years in which to adopt what's happening. And they're going to co-create and co-develop with businesses, advisors, and everything to make sure that all the standards dovetail. They are not introducing digital real-time reporting at the same time. If they do decide to do that, if they do decide to introduce digital real-time reporting, it will be done at a later date. So that's as far as we've got with e-invoicing at the moment. There's been a huge consultation. The responses are out and the government responses are out for people to read. And there will be further consultation throughout 26 and 27. So that's an update on the UK, and hopefully it will then roll it out in 2029. How it dovetails with the EU and how it works for overseas businesses isn't exactly clear at the moment, but as soon as we have any information, we will update you. Okay, so am I able to move the slides? Or do I need to oh no, here we go. So, all right, you're okay. So e-invoicing and digital reporting, B2B. At the moment, a lot of countries do have B2G in their own domestic environments, but it's B2B for VIDA. It will have what's called a 5-corner model. So you've got the supplier and the buyer at either end of the chain, as you can see. The supplier will issue the transaction data through its system. It will send that mandatory data to the National Tax Authority within 10 days. That is a longer period than was originally envisaged. It was going to be 2 working days. 2 working days was proving difficult to actually ascertain, as each country has different working days when there's public holidays. So, for any business based outside the EU, it looked like it was going to be really tricky. So that was a really good advance in the fact that we've now got 10 days in which to submit the data. The e-invoice will then go to the buyer's system, and the transaction data will go to the buyer, and then it will also be reported to the National Tax Authority in the buyer's domain. So there's a swap of information in terms of the National Tax Authorities. And as somebody pointed out to me I was very privileged to go to Bangkok a few weeks ago, but someone pointed out in my session on e-invoicing, one of the things e-invoicing can do is give greater transparency for the tax authority over what the businesses are doing. So whilst it's a great thing for businesses, the more cynical ones in my audience pointed out that the tax authority will have more visibility over what you do. So and that to an extent is going to be true. And of course, the EU member states do swap or do share data. They do that already. So there's already a lot they know about your transactions that you may not know. So it is an improvement on that. It will provide greater transparency, and it will be easier for businesses once they've got their software and everything implemented. And that's always the trying time. And it takes a long time because you have to have a budget and you have to have the work done, and you need to know what the protocols are. And I mean, I've looked at the regulation, the EU regulation for the data, and it may as well be in Martian because it's all in computer speak, but the software developers will know exactly what it is that they need. So by having one EU standard across the board from 2030, it means that any business should, in theory, be able to transact digitally. And then the individual countries will align their standards by 2035 with the EU one. And the law does actually say they can use another standard, but they do have to allow businesses access to the EU standard. So that's what we're looking at. Okay, so next slide.
Ruth, I just added two little
Oh, right.
arrows.
Yeah,
Because
so is that the centralized
yeah.
data hub that they're
Yeah.
envisaging? So everything will feed into a centralized data hub. It will be visible to the member states in the same way as you have a limited amount of visibility via the VISE system for cross-border transactions, being able to check VAT numbers and things like that. The VISE system will be enhanced as a result. Okay, so as I said, there will be a mandatory e-invoicing single European standard. It's for cross-border supplies. For domestic supplies, it doesn't need to go through the European standard. There will be digital real-time reporting requirements to replace the recapitulative statements. They're known as VISE statements in some countries, EC sales lists. That's where you record your cross-border sales of goods and services. So that will now become more real time. In fact, it will be real time. There is a very short period of time in which you have to submit the data for those reports. The VISE system will be enhanced to be able to assist with identifying taxable persons. So at the moment, if you've ever had to check an EU VAT number, depending on which member state it is, you will get a greater or lesser amount of detail on that taxpayer. So the VISE system will be upgraded to actually be able to identify more clearly taxable persons, which is a good move. And will help with the due diligence that you should be doing around your cross-border transactions and also your domestic ones. E-invoicing format will be the default for cross-border suppliers. You won't be able to use PDFs or Word documents. It will be the default. You can't use anything else. And all of the EU standard format will be mandatory in the EU member states for cross-border. You will, or your clients will, end up with the loss of right to exempt or zero rate transactions if the e-invoices or digital real-time requirements are not met. So it does have very, very severe implications, and there's nothing worse than souring a business relationship if you don't get the data there for your supplier to be able to zero rate or exempt your transaction. Then you will end up with the VAT that you may or may not be able to reclaim from the member state where your supplier is located. So there is a big onus not only on the suppliers to do e-invoicing and provide data, but also on the recipients to do so. Okay. So the DRR, or digital real-time reporting, will apply to any business identified with a VAT registration number in the EU for cross-border supplies of goods and services. And one of the limitations of the VISE system at the moment is that if you have people who are not normally transacting cross-border, they do not appear in that system. So sometimes you can do an identity check on the VISE system and find that your supplier or your customer are not registered there. And that's because with their domestic tax authority, they are not registered for cross-border supplies. So it's really important to make sure that both parties are registered to be able to carry out cross-border supplies. The DRR will be on each transaction. So that is an awful lot of data that needs to be given on every single transaction. So it's a line by line transaction. You have a 10-day window in which to issue the e-invoice. You have a slightly shorter period of time to do the digital real-time reporting. And it's all coming into effect on the 1st of July 2030. So we're talking just under 4.5 years away, or just over 4.5 years away. That isn't a long time when you have to get software up and running, conforming, tested. And in the meantime, you may have e-invoicing running in parallel in different member states with different standards. So that's an awful big ask for businesses to be able to get that up and running. I'm not saying it's not possible. It will be possible. It will have to be possible. But businesses really do need to focus now on what they need to do in 4.5 years' time. So the main changes, we've got mandatory reporting for intra-community supplies of goods or services, where goods or where the supplier is not established in the member state of the recipient. So that is one of the definitions of cross-border. Obviously, you've got 2 different states. There will be a new definition of an electronic invoice. That's going to be defined in Article 217 of the Principal VAT Directive. And it means an invoice that contains the information required by this directive and which, at least in relation to the data referred to in Articles 262 and 271b, has been issued, transmitted and received in a structured electronic format, which allows for its automated and electronic processing. So the key 3 words there are issued, transmitted and received. If there is any glitch or any bump in that sort of system, even if it's been issued, if it hasn't been transmitted and received, it's still not properly an e-invoice. So all 3 have to be fulfilled. Article 218, sub 3 of the Principal VAT Directive will be changed to make it obligatory for member states to accept the European standard and directive, which is Directive 2015/55 for transactions under Article 138 of the Principal VAT Directive. So basically, it's saying that the Principal VAT Directive will be amended to make sure that the e-invoicing can be adopted smoothly. As I mentioned earlier, member states can adopt other electronic standards compatible with the EU standard, but it must have the European standard available. And that's to make it easier for non-established businesses in particular, where they then don't have to worry about multiple different standards. They can just go for the EU standard. the member states will still be able to allow paper or other invoice formats, but that are for supplies that are not covered by the mandatory e-invoicing. So, for example, domestic supplies. There is no mandation for domestic supplies to be covered. That is a slight difference to the UK, where UK domestic supplies appear to be covered by the proposals. So it's only cross-border at the moment. Invoices, again, I've said, issued within 10 working days of the supply, and there will be a new article in the Principal VAT Directive to replace that. Tax representatives, which have a particular status in law, or agents issuing invoices in the name of a taxable person, also have to comply. So even if you are not established in the EU anywhere, but you are required to have a tax agent or a tax representative, and there is a difference between the two, those tax representatives and agents will be the ones that have to comply. And if you've got batches of invoice being sent to the same recipient, the details common to the individual invoices need only be mentioned once. So that's things like name and address, VAT number, etc., etc. But you have to make sure that that background information is accessible for each invoice. So whilst you may only mention it once in the data transmission, you still have to have all of the details on the invoices in the background. So what is a digital invoice? Well, it will have all of the current requirements of Article 226 of the Principal VAT Directive, and that's the part of the VAT Directive that lays down for every single member state what should be in an invoice. And that is things like the supplier's name, address, and VAT number, the recipient's name, address, and VAT number, a description of the goods or services sufficient to be able to identify those goods and services, a sequential number, a tax payment date if that's different to the actual date of the invoice, the number of units, the rate of VAT, the things that we're all really used to putting on a VAT invoice at the moment, obviously why there's no VAT, things like that. But in addition to that, you're going to have the IBAN number of the supplier's bank account to which the payment of the invoice will be credited. If you can't have the IBAN number, then another identifier which categorically identifies the bank account to which the receipt of payments of the invoice will be credited. So that's a new one. A lot of invoices that I see do have the IBAN number on and the banking details, but this will now have to be digital. And the date on which the payment of the goods or services is due, or if there are partial payments where you're paying in instalments or a deposit, the date and amount of each payment. And if you've got a corrective invoice, the sequential number which identifies the corrected invoice. So if you are correcting an invoice for whatever reason, you need to refer back to the original underlying invoice. Member states must still allow persons to use the option to issue summary invoices, and that details supplies of goods or services, provided that the VAT due is chargeable in the same calendar month, so you can't have them bridging a calendar month. And summary invoices are used a lot where the value is quite low, so it makes it easier to issue the invoice. They too must be issued within 10 days of the end of the relevant calendar month. So they've still got 10 days, but from the end of the month, not the tax point. And member states can revoke this right if there are fraud sensitive sectors. But the VAT committee must be notified if a member state applies this option. So Stephen referred to options, but I've got an echo somewhere. Stephen referred to various options that are within the legislation, which were brought in to smooth the path of VEDA, but this is one of them. So if the member state wants to revoke the right to issue summary invoices, it does need to notify the EU VAT committee before it does so. Okay. Digital real-time reporting, and this is a new thing. So where you are looking at issuing e-invoices, you've now got digital real-time reporting to go in conjunction with it. So this is where you, as I said, are replacing existing documentation in a digital format that can be read by the tax authorities. Now, at the moment, with EC sales lists or VISE reports, it is possible for member states to ask another member state to investigate whether or not the recipient has correctly accounted for the VAT. This will make this much easier and smoother and be more transparent for member states to do that and to check that VAT isn't leaking out of the system. It applies mandatory to cross-border supplies, but member states can opt to use it for domestic supplies. At the moment, as far as I'm aware, we have no indication of whether any member states will opt to do this. But the UK is looking at it, and as it's not a member state, but the UK is looking at it, but hasn't come to a decision to use digital real-time reporting at all. So any supplier identified for VAT purposes must submit a recapitulative statement to the member state in which that person is established or identified for the intra-community supply of goods, and that's Article 2621. And it's going to be amended to reflect that this statement will be replaced by electronic data. So you will see new legislation coming through in the overarching Principal VAT Directive. Member states must allow for the transmission of data from e-invoices, which comply with the EU standard. And its list of syntaxes, and this is where it might as well have been in Martian, because that's where it lost me when it got to syntaxes. And member states may allow for the transition of data from electronic invoices using other data formats. So it's running in parallel with e-invoicing, but everything has to be interoperable with the European standard. So the common electronic message for providing the detail is going to be determined in accordance to a procedure referred to in Article 58.2 and a new Article 2632 of EU Regulation 904/2010. And that's quite a deep and detailed regulation. But basically what it says, the following persons will submit the data for the acquisitions of goods under the relevant part of the Principal VAT Directive and or services from a non-established supplier under Articles 194, 197 and 204. So Articles 194, 197 and 204 allow for various reverse charges where a supplier is not established in the territory of where the goods are located or where the services are performed. And it allows for the reverse charge, which means that the recipient accounts for the VAT. It is a widely used anti-fraud measure. It means that it's much easier, I guess, to get the VAT off the recipient than it is a non-established supplier. But it does mean that there is a very, well, almost impossible for VAT to leak out under using a reverse charge. So Article 21 or 22 of the VAT Directive, the acquirer of the goods will need to submit the data. Under Article 42, which is an acquisition followed by an onward supply in the same territory, the initial acquirer, and they have to provide their VAT ID, and then the VAT ID of the subsequent taxable person and the net value of each supply made by the initial acquirer. So they've got a bit more data to do. And this will be a new Article 265. That is for goods. For services, we've got Articles 194, 195, 196, 197 and 204. And for this, the person required to submit the data will be the recipient of the supply, and they are the ones required to account for the VAT where their supplier is not in their territory. So whilst the recipient is going to have to do the data or submit the data, they are going to need the data in the first place. And if they haven't got that data and don't submit it in under the timeframes, then there is a danger that there will be VAT charged in different EU member states. So you do need to, if you're not established in a member state, then you do need to make sure that you have that data and it is transmittable. Okay. So you have no later than 5 days after issuing the invoice or the date that the invoice should have been issued. So in some ways, it's a great way of tightening down on making sure that invoices are issued at the correct time, which is a big problem in all EU member states, I think, and also in the UK. And it has to contain this information: the date of the issue, a sequential number based on one or more series which identifies the invoice, the VAT identification number under which the taxable person supplied the goods or services, and the customer's VAT identification number under which they received the supply of goods or services, and to show that they are liable for the payment of goods, a payment of VAT, sorry. So it's looks like not a lot of data at all, but you still have to have this transmitted, otherwise the whole thing falls down and any exemptions and zero ratings will be lost. And then there are penalties for not complying as well. So you move on to the quantity and nature of the goods, or the extent and nature of the services rendered, the taxable amount per rate or exemption, and the unit in price exclusive of VAT. And if you're looking at the list, you will think, well, that's very similar to an invoice, and it is. It's a slightly shorter data set than the invoice itself. So you've got discounts in there, you've got whether or not there's self-billing, whether there's an exemption, so, you know, reverse charge, or it might be a national exemption. If there's a corrective invoice, then the sequential number which identifies that corrected invoice, the bank account numbers, again, similar to the new data required on e-invoices, the date on which the payment of the goods or services is due. So hopefully with e-invoicing, when it comes to doing the DRR, most of the data should, or in fact, all of the data should already be there. It's just making sure that you don't over-report or under-report. So as I said, it's slightly less than the information required on a tax invoice. But what it does also mean is that dispatches under Article 138, which is the movement of goods, an exemption will not be granted if the supplier has not complied with submitting the data, and for there to be an offset of acquisition VAT, where the person whose VAT ID is not in the member state of acquisition, and the acquirer in the member state where the acquisition ends has to submit the data. So you're going to find that there will be greater scrutiny, I think, and greater transparency on intra-community movements, particularly of goods. A bit more difficult on services because they don't physically move. But when you look at what they want to do with the other two pillars of VIDA, you can see that the data that's being transmitted is going to be really useful to the tax authorities for the other pillars too. Domestic supplies, it's saying that it allows member states to require taxable persons established or identified to electronically send their tax authority data made within the member state. It's not mandatory, but that Article 271A will give the mandate for member states to choose whether they want to do that. There's a new Article 273 of the Principal VAT Directive, which will allow member states to impose other obligations on taxpayers deemed necessary to ensure the correct collection of VAT and to prevent evasion. So we all know that VAT evasion goes on. I should imagine, as a professional body, certainly not the ICAW and the Institute of Tax here, you would not want to be dealing with people who are dealing in the field of evasion, but it happens and we have to work out how to deal with it. So a member state can impose other obligations, but there is a requirement that any obligation they put on has to be equal between domestic and cross-border supplies, and does not give rise to more formalities connected with the crossing of borders. So you can't make it more difficult to do cross-border supplies by implementing anything under Article 273, but you can enhance what you do within your member state to make sure that there is no loss of VAT. It can't be relied on to impose additional invoicing obligations over and above those already required under the e-invoicing rules, or to introduce any additional general transaction-based reporting obligations. So you can't have more obligations in one member state than the other. They can enhance what's already there, but they can't exceed it. And member states may require taxpayer to store data on their transactions for the purposes of preparing and submitting a VAT return for auditing purposes. So there's an interaction there between the e-invoicing and the preparation of the VAT return. In reality, what we will probably see is that the software packages, the accounting software packages in different member states will probably dovetail the two so that when the e-invoice is issued, it automatically feeds into the VAT return. But you do need to store that data so that it can be audited. Member states that have a general transaction-based reporting obligation as of the 1st of January 2024, so nearly 2 years ago, for the acquisitions of goods and services other than those in Article 262, can maintain those until the implementation of a digital reporting real-time reporting system in accordance with VIDA. And member states will have to adopt and publish their laws, regulations and administrative provisions by the 30th of June 2030, literally the day before, unless they have a digital real-time reporting system in place as of the 1st of January 2024, when they have to implement the VIDA package by the 1st of January 2035, relating to the domestic transactions. So there is a bit of a carve out there. If you're already operating under a DRR, then you do have a period of grace in which to implement. But by and large, member states will need to implement by the 1st of July 2030, and each member state will have their own laws, regulations and administrative provisions, and we won't know necessarily what those are until potentially by the day before it applies. So not a lot of time to study 27 different bits of legislation in numerous languages. We're hoping that they do bring it in a bit earlier, but they're not required to until the 30th of June.
Thanks ever so much. You're absolutely right. I mean, there's a huge amount, if you like, that's got to be done, both by member states, administrations, and by business, between now and 2030. And as I said, the Commission is watching this very carefully, trying to make sure and provide the help where it's needed. They know that the business administration can actually cope and actually, will actually be ready by that date, to switch over to full electronic invoicing, digital reporting, for the objective of reducing VAT frauds and major issue, but also, of course, to make life easier both for administrations and for business at least cost. Just before we go into looking what other countries are doing, I just want to kind of take one example of digital reporting, which will take effect in 2030. And this will be relevant to any business which is making supplies, undertaking transactions in one member state when that business is established in a second member state. So the transactions take place in, let's say, Germany, but the business is established in France. As at today, so in 2025, there is an optional regime in place which allows member states, if they so wish, to provide for a reverse charge mechanism whereby the non-established supplier, so in my example, the French company, does not have to register and charge German VAT if Germany has opted or exercised this option, as the German VAT will be accounted for under reverse charge mechanism by the German client. So he has to be VAT registered, and Germany to be able to do that, to be able to account for the German VAT. This directive, the original 2006 directive, was modified and will it take effect from July 2028. And this optional provision, whereby member states can allow or not businesses to account for reverse charge, will now become compulsory in the sense that any non-established business making supplies in a member state in which that business is not established, making supplies to a VAT registered customer in that second member state, then it will no longer be an option for member states to allow that. Member states must, if you like, provide for a reverse charge mechanism. However, in the process, the legislative process between December 2022 and the date when all this legislation was adopted or entered into force in April 2025, there are a number of changes that were made. And in particular, one of the changes that was made was to introduce more options. So we got rid of one option, which was to say that member states now have to allow or provide for a reverse charge mechanism when supplies are being made by a non-established taxable person to a taxable person or a VAT registered person in the second member state. What happened in the negotiation process, was that we now have more options having been introduced. Well, the easiest way to illustrate this is with a couple of examples. So the first example, still using my French supplier but German customer, but it's slightly different in the sense that here the transactions take place in France. So we have a German company which buys goods in France from a French supplier, and that German company, it on supplies those goods which stay in France, on supplies those goods to a French VAT registered customer. So in principle, what should happen with effect from 2028 is that the German customer will not have to register French VAT. He will be charged French VAT by his French supplier because the goods do not physically leave the French territory. And that German customer will on-supply those goods to a French customer, and that French customer, being, in the example, VAT registered, will account for a reverse charge. The VAT, though, which is charged by the French supplier to the German customer because he isn't VAT registered in France, that German customer will have to claim that French VAT back through the cross-border VAT refund mechanism as set down by Directive 2008/9. Now, why have I shown this one? Well, I've shown this one because this is the relatively simple scenario. And as a first stage, the German customer, which is not VAT registered in France, will, according to the way that the directive is currently drafted, will not have to undertake any separate VAT reporting, either under digital reporting requirements, certainly not e-invoicing requirement at this stage, because at this point, there is no cross-border transaction taking place. It's purely domestic. Goods remain in France. The French supplier sells the goods in France to the German customer. Those goods remain in France. The German customer sells those goods onto the French client. Those goods remain in France. And the French customer accounts reverse charge. Now, as I say, the wording of the directive leads to the impression, in this particular case, that there is no other reporting obligation that falls on the German customer. It's logical in the sense that as the German customer is not VAT registered in France, to impose upon him a digital reporting requirement to report the fact that he has sold goods effectively VAT-free to a French company, which will then reverse charge the French VAT on that supply, on that transaction, would be perhaps disproportionate, taking account that that German customer is not at this point VAT registered. So how that will work in actual practice, there is, in my view, still a substantial risk of VAT fraud, because the German customer, not having a French VAT number, is not VAT registered in France. He's not charging French VAT. The VAT collection is being undertaken by the French client, who's VAT registered by a reverse charge mechanism. But where's the check and balance to make sure that the right amount of VAT is collected and accounted for by the French client on the goods it acquired from the German company? Under domestic rules, so under French domestic rules currently, again, this will change. So this transaction being wholly within France, the French domestic rules currently do not require e-invoicing to be undertaken by the German customer. So the German company supplying the goods to the French client. But under French domestic rules, the French client will have to e-report the French authorities. So even though there's no intra-EU transaction, no cross-border movement, this is a purely domestic requirement. The French client will have to report that he has acquired goods from a German customer who is not established in France, doesn't have a French VAT number, which will allow the French authorities then to track and ensure that the French client correctly accounts for reverse charge in France. Now, all of this is, of course, assuming that all of the businesses concerned, and particularly when it's not established businesses, all apply the rules appropriately, correctly, and on a timely basis. If, however, in the second example, the German customer is now VAT registered in France, the amended Article 194 does allow member states, it's an option that the directive allows or provides for. It says that where the non-established supplier, so in my example, a German company, supplies, in my example, goods to a French VAT registered client, and that German customer is already VAT registered in France for some other purpose. We're selling goods that's on a B2C basis in France, so he has a French VAT number. Then that German company can issue an invoice to his French client without French VAT on it, indicating that the French client must reverse charge the French VAT on the supply that he's received from the German company. That transaction will have to be reported under the digital reporting requirements of the famous recapitulative statement in paper format from 2028 to 2030, and then from 2030 onwards, that will be a digital format that will be used to record those goods being supplied by the German company to the French client, even though that is a purely domestic transaction in the sense that the goods never left France. So it's not a cross-border EU transaction, it's a purely domestic transaction, but nonetheless, the EU legislation will apply to the extent that there will be a requirement by the German company to file a recapitulated statement to state and to indicate that he has sold goods in France to a French customer, and that French customer will account for a reverse charge. And because the German company, in my example, does have a French VAT number, he can claim the French VAT that's charged to him by the French supplier back from the French authorities through his French domestic VAT return. This was something, an amendment that was introduced at a relatively late stage to the directive at the request of German businesses. The German Business Confederation requested this as, in their view, a simplification measure. Whether it's going to simplify matters both for the business and or for administrations, I'm not too sure, because a German company VAT registered in a country, he's going to decide whether to charge French VAT or not charge French VAT. He has to inform the French administration if he's going to use the reverse charge mechanism. What happens if he doesn't do that? It's all going to, I think, in my view, get particularly difficult, particularly or become particularly cumbersome for business to manage. Last scenario, more kind of classic one, which the member states again adopted at a fairly late stage in the directive. We have the German customer, he's VAT registered in France. He decides to charge French VAT. In other words, he doesn't opt, if you like, for the reverse charge mechanism to apply. Consequence of which he charges French VAT to his French client. The French client gets the French VAT back through his own French VAT return. And of course, the German customer, the German company, claims back the VAT that's charged to him by the his French supplier on his French VAT return. So that's just to illustrate that in certain circumstances, for essentially the same transaction, we'll have a digital reporting requirement at EU level. For others, we won't have a digital reporting requirement. at an EU level, but there might be a requirement at a domestic level within the member state in which the transactions take place. And businesses have to work their way through to decide or determine, literally on a kind of transaction by transaction basis, member state by member state basis, whether they have to do a separate digital reporting, what format is that, who does that go to, and so on and so forth. Just to finalize the example, this is more classic. We've got a transaction involving a final consumer in France, not a taxable person. Clearly, a reverse charge can't be applied in those circumstances between the German supplier and his French client, French customer. So, classic situation: French supplier will charge French VAT to the German customer. German customer may register French VAT. There are possibilities under the extension in Pillar 3 to the one-stop shop, whereby the German company does not have to register French VAT, but will declare any transactions subject to French VAT through the one-stop shop mechanism. But the VAT charged to the German company by his French supplier can only be claimed back if he uses the one-stop shop through a cross-border VAT refund mechanism. If he is, of course, registered for VAT in France, then the German customer can claim any French VAT charged to him, subject to the normal rules, of course, back through his French VAT return. Rose, over to you for a question.
Okay, so we've got a poll question, and it's an ideal time to break. That's an awful lot of information to take in. Having listening to the changes under Pillar 1, how confident are you that you or your clients will be ready for the changes in 2030? So we've got options of very, somewhat, not sure, not at all, or what changes. So if you'd like to put your answers in, I believe there's a link that you can use to put your answers in, and we'll get a result of the poll. We'll give everybody a couple of minutes to do that.
Members are requested to go to the feedback. Members are requested to go to the feedback option given at the bottom of the screen and submit their view on the particular questions. All the members kindly request. Members are requested to go to the feedback option given at the bottom of the screen and submit their view on the particular questions. Thank you.
Okay, has everybody had a chance to vote? We got answers coming in?
Technical team, can you please help?
Have we got the results of the poll? Okay. Okay.
Sir, sir, we have received 20 feedbacks, 20 polls, and we are sharing it with you on mail.
Okay. I think it's now going on to the 2 individual states, Stephen.
Okay. We soon pick up the results of the poll. Anyway, so as I mentioned at the top, the EU Commission's VIDA proposals, they've been a long time um, in being adopted rather. I think actually we're going to kind of look backwards. I think we started having the discussions around how we can actually bring the EU's VAT system into the 21st century, probably 20 years ago. So it's taken a long time to get to where we are. One thing just to mention though, before we look at what 2 EU member states have done, if like in that kind of interim period, as whilst waiting for the EU proposals to be finalised, is just to perhaps just remember that these changes, even though they are the most substantial changes to the EU's VAT system since 1993, why 1993? That was the date on which the internal customs borders, customs frontiers between the EU member states were abolished, which obviously was a fundamental change to the way the EU VAT system operated at that point in time. But it's not the end of a process, and the Commission is very conscious that even once all this legislation, the VAT legislation, has been adopted and implemented, and that looking out to 2035, so it's over the next 10 years, it's certainly not the end of the story in the sense that there's still a lot more work to be done to bring the whole of the EU's VAT system into the 21st century. There's a separate project that's being run at the moment. It's called the VAT after VIDA. So what the EU's VAT system might look like after VIDA has been adopted and implemented. That project is running. There's some work being done until the end of this year. We hope that the Commission will publish the work that's been done. There's a huge amount of work that's been done with 200, 300 stakeholders being contacted, interviewed in relation to what they think or how they think the EU's VAT system might be improved in addition to the VIDA proposals, or rather not proposal, but the VIDA implementation. We'll have to see what the Commission does. The Commission, of course, main concern, main focus at the current stage, of course, is just to get the VIDA proposals as adopted rather, actually implemented in the timeframes which are set down. And so it's probably unrealistic to expect there'll be any substantial changes to the EU's VAT system, apart from 1 or 2 smaller areas. I won't call them minor, small areas around the travel agents, tour operators, and perhaps financial services. But it's unlikely that much will happen on any of those other pieces of work, perhaps travel agents, within say the next 5 to 10 years. So it's a step forward, clearly, in terms of bringing the EU's VAT system up to date. But there's also a huge amount of work that still needs to be done to make the EU's VAT system fit for purpose, and to take some of the benefits and learn some of the lessons from countries like great countries like India, which have implemented their own GST VAT systems much more recently. Got to think about New Zealand, we think about Singapore, Australia, who actually have a far simpler VAT GST system than the VAT system currently operating in the European Union. So there's a lot of work needs to be done. What time frame, what resources will be available to actually make any of those changes, we'll have to see. But the Commission, business, member states administrations are all very conscious of the fact that there's still an awful lot that needs to be done to modernise, if I use that expression, the EU's VAT system. Just taking 2 countries, so 2 EU member states, to look to see what they have done in relation to adopting e-invoicing, e-reporting domestically. So these are transactions within that member state. So I'll start with France. Originally, France was going to introduce invoicing, e-reporting for all businesses by 2024. That timeframe slipped, and the implementation dates now are next year for most businesses in terms of size, and then 2027 for all businesses. So it's not something that's going to happen overnight. It's taken a lot of time, effort, energy to be introduced. And what we'll see when we look in a bit more detail at the French system, we'll note that it's not exactly like the EU's system that Ruth greatly set out for us earlier. So just looking at a bit more detail as to why France introduced the invoicing. Actually, it's unlike Germany. The clear objective of the French administration, the French government, is to substantially reduce the level of VAT fraud. It's estimated, that's in 2019 numbers, that it was over 15 billion euros. Latest numbers that are available for 2020, which was for 2023, indicate that VAT fraud level is around now 20 billion per year. These are per year numbers. Secondary objective is to reduce reporting costs, simplify reportings, and ultimately produce pre-filled VAT returns. So the businesses will no longer have to enter all the different boxes on a French VAT return. There are actually quite a lot on a French VAT return. It keeps changing, but there's just on VAT on its own, there's probably about 34 boxes, 35 boxes on the French VAT return. If you include all the annexes to the French VAT return, there is in total probably something like 150 boxes to be completed. And VAT returns in France are at the moment monthly. So you can see the huge potential for simplification that e-reporting invoicing might introduce to enable businesses to just kind of sign off on a pre-filled VAT return rather than have to think about which one of the 150 different boxes any one number has to be input into. So simplification, reducing costs both for business and administration. And business, by reducing costs, improves their competitiveness. And of course, for the government, it actually enables the government to more appropriately steer the economy because they have more data on a real-time basis. They can actually see how business is developing, evolving. And that obviously helps government use tools, perhaps in a more kind of targeted manner to drive the economy. So this is how it's going to work. This wasn't the original proposal. The original proposal, in fact, was actually a slightly simpler diagram, where in fact the relationship was to be directly between the supplier, what's called a PPF in the middle, and the customer. And the reason for that was that for B2G, so business to government transactions today, they all have to be electronically invoiced. They cannot be paper invoiced. They have to be done electronically. And that system called Chorus has worked well. And it was only at a very late stage that the government decided not to go that route and to in fact involve independent, I'll call them private enterprises called PA1 and PA2. PA just stands for authorized platform. And essentially the way that the system will work, and as I say, it will work for all businesses having to receive invoices from 1st of September 2026. So the customers on my diagram will have to appoint, find, work with an approved platform, in my example, platform 2, because that platform must be able to receive electronic invoices on behalf of the customer and transmit those invoices to the customer. If the customer's own IT system, it's actually the same for the supplier, but if the customer's IT system is not able to receive the data as provided to it in the format provided to it by the approved platform, the PA, then the customer will have to appoint an independent software provider to act as the interface between the platform and the customer. It's called an SC. And again, similarly for a supplier, if his data is not in such a format that the PA can use that data to provide the electronic invoice, then the supplier will also have to nominate an SC who will kind of interpret, should we say, the supplier's data into a format that the PA can use to produce the electronic invoice. So the invoice, which is electronic, it can't be a PDF, it can't be a Word document, it has to be electronic in the format that the French government has set down. Again, the government has accepted that the European Union format for data transmission will, of course, be accepted. So that data will be transmitted in either the European format or in a French domestic format. At the moment, there are 3 formats being evaluated for France. One of them, in fact, will provide, alongside the electronic invoice, a document which will actually be readable by the customer. And readable in the sense that it will actually enable the customer to produce a PDF of the electronic invoice. It's only being done not, if you like, as a kind of a tax document as such, this PDF document. It won't be a tax document. It won't allow the customer to claim any input VAT on the transaction with his supplier. But what it will do, of course, enable the customer to actually see what the transaction is. So rather than having to try and interpret the computer code, work out what the underlying transaction actually is, he will be supplied with, alongside the e-invoice, a document in PDF format, which you can actually read and understand. The PAs then, they communicate the data, so not the invoice. They communicate the data to the PPF. The PPF is the government's platform. And that data then is transmitted to the French authorities. And the French authorities then effectively see the transaction more or less on a real-time basis. And it will be on a more or less real-time basis. So whilst in the initial stages, there will be delays, or accepted delays rather, over time, the government's clear intention, in fact, is to make sure that this data is transited on a more or less real-time basis. Again, with the objective of limiting, if not removing entirely, VAT fraud from the system. Now, the electronic invoice, though, will only be an obligation on transactions between taxable persons for VAT purposes. Now, a taxable person is anybody that is carrying on an economic activity on a continuous basis, etc., does not mean that the recipient of the invoice has to be VAT registered. It just has to be a taxable person. So, for example, if the taxable person was a self-employed doctor, let's say, the doctor will not be VAT registered because his transactions will mostly be exempt from VAT, therefore not requiring a VAT registration. But he'll nonetheless have to go into the e-invoicing system to be able to receive e-invoices from businesses which themselves will charge the doctor VAT on, for example, the doctor's electricity bill, on his telephone bill, on his internet access bill. All of those bills will have French VAT on, and the doctor, therefore, must appoint his PA, his approved platform, to be able to receive in the appropriate format these e-invoices from these French suppliers. Now, this is causing of itself, as you might imagine, some concerns and difficulties. These very small businesses, the doctors, the self-employed doctors, they fail to understand the need, the benefit to them of having to appoint a platform to receive e-invoices in order just to be able to pay their suppliers. So, but that's unfortunately where we are at this present stage. Whether that will evolve over time between now and September next year is not clear. Clearly, what is now happening is that these small businesses, these doctors and other businesses not VAT registered, are becoming aware that they need to do something, need to take some action, and need to pay some money, because these platforms are private platforms. They're not paid for by the government. So they have to pay to have the right to receive these e-invoices from their French domestic suppliers. There will also be an obligation to transmit data. So essentially, those transactions which do not fall within the scope of e-invoicing. So e-invoicing at this day, as a reminder, in France, is only between VAT taxable persons established in France. So if they're not established in France, there will be no e-invoicing obligation. However, there will be an e-reporting obligation, whereby the French established business will have, through the e-reporting obligation, which will follow the same route as for the invoices. The e-reporting will have to be undertaken by the French established business to report transactions, even with customers who are not established, or not VAT registered, they're not in business at all. So, for example, private consumers. All this needs to be done and in place, up and running between now and the 1st of September 2026. The government is very confident that this will be done, but looking at the number of queries and the questions that are coming out from business, I won't say on a daily basis, but on a weekly basis, to how all of this is actually going to work on day one, starting from September next year. It is clear, if you like, there's an awful lot of work that needs to be undertaken between now and, well, now in 9 months' time. This is just an example of transactions which will have to be e-reported in France. I won't go to the table in detail. You'll have a copy of these slides will be circulated after this webinar. But you can see that with the various different types of transactions being undertaken, which do not require e-invoicing, the obligations falling on businesses to undertake e-reporting will be quite substantial. And as Ruth pointed out, the level of detail that's going to be required is essentially the same in France as it will be at EU level, including payment details, the bank details of the supplier, the IBAN code, the terms of payment, in other words, when should the invoice be paid. And this will be even more relevant in France because certain transactions are only subject to VAT, or rather VAT only becomes due as and when the payment for the transaction is received by the supplier. So the supplier does need to know when he's going to get paid and at what date that payment takes place. The system will be relatively transparent in the sense that the platforms have the obligation to provide both to the supplier and to the customer details of the payment cycle, so the supplier knows when he should get paid, the customer knows when he has to pay, and the platforms will be set up in such a manner that the supplier will be informed if payment is not received at the appropriate time, and the customer will also be told of his payment deadlines and the fact that he's missed one or two, and the supplier is waiting for payment. So potentially a huge amount of data. At the moment, the websites and the Q&A sites are all in French. The objective of the French administration, though, is to make them, once the situation is stabilized and the Q&As don't stop changing, should we say, on a kind of fairly regular basis, that all the data information will also be provided in English. I don't think at this stage an intention to, unfortunately, include other languages on the French administration's website, but at least it won't just all be in French. There will also be the opportunity, not just yet, but eventually, of having the information available in English as well as in French. The other country, and this is more recent, Ireland, and again, thanks to our colleagues from VATCalc for this slide and the earlier one about the EU VAT invoicing system, EU invoicing system. Their kind of graphic design skills are far better than mine. We do have their permission to circulate this document with their slides in them. So again, many thanks to our colleagues at VATCalc for doing all of this. The Irish system is very much like the EU system, much simpler in format. So the supplier sends the transaction data to the e-invoicing service provider. The data is then communicated through the selection that seems to be adopted by the Irish is the People Network, which is a data transmission protocol. that data gets transmitted to the buyers, the invoicing service provider, and the e-invoicing service provider then transmits that data through an invoice to the buyer. Not quite sure yet whether Ireland will also, as France has done, provide, if you like, a kind of parallel readable document at the same time as the data is transmitted electronically. We'll have to, I think we start to wait and see what the Irish intend to do on that score. With data, of course, being provided to the Irish Revenue on the objective being for that data to be received by the Irish Revenue on a more or less real-time basis. So very ambitious. With intention to implement all of that by November 2028, early 2029. So it is happening very quickly in Ireland. And again, wait to see what happens. What, of course, as I mentioned earlier, is interesting that this schema is obviously very similar to the EU's, and as a consequence of which, when Ireland has to ensure that its e-invoicing system is compatible with the EU system by no later than 2035, I don't think it will pose many kind of difficulties for the Irish to adopt, if like, the EU standard, because it's essentially what they're doing anyway. Rose, a quick polling question.
Well, we've already got the results in because everybody neatly answered them with the first one. So the first poll result, we've got 42, nearly 43% say they're very ready or their clients are very ready, and 52% saying they're somewhat ready, and then just under 5% saying that they're not sure. And the number of respondents were very 9, somewhat 11, and not sure 1. And then for the second poll question, which was answered at the same time, which is, do you think the proposals in France will fulfill the objectives? Overwhelmingly, 90.48% say yes, and 9.52% say no. So, and no don't knows, which is good.
Yeah, but I think that's well, as I say, we'll have to wait to see what happens. The deadline being the 1st of September next year for the implementation of the invoicing system. As I say, there is pushback. More and more people are becoming aware if this obligation is coming. And as I say, in particular for the very, very small businesses, those aren't VAT registered, but they are considered to be taxable persons. The pushback is coming from them on the basis that they just really can't see what the point of doing it is, because there's actually no benefit whatsoever for them. It's actually going to make their life more complicated and more expensive than receiving PDF invoices from their suppliers as of today. Just very quickly on the OECD, and RK is very, very much involved in this work. What the OECD is trying to do is to say, well, there's all of these initiatives on e-invoicing and digital reporting requirements going on at global level. Would it not make some sense to at least agree on some very kind of broad guidelines, so that when various countries around the world are thinking of introducing DRR or e-invoicing, we try and adopt, shall we say, at a global level, similar schemas such that businesses operating globally, they don't have to deal with however many countries have a VAT system, which is about 176, I think, being faced with 176 different e-invoicing and e-reporting systems. So that's been done. Now the actual work is going to be published. I think it's all now being finalised. The work on this, the actual guidelines will either be published before the end of this year, probably more likely, I think, RK, that they will be presented and published at the global VAT forum that's taking place here in Paris at the end of next month, end of January. As I think illustrating all of the great work that's being done by all the countries on a consensual basis. So there's no kind of obligation for all members to unanimously agree, all OECD members rather, to unanimously agree to anything that's produced in these guidelines. They're produced on a kind of consensual basis. So we'll have to see, if you like, at what point in time the document actually is published. I must have checked in the last couple of days to see whether it's been produced or not. But I think there was some discussion that it might be produced or published. Sorry, formally published by the end of the year. But there's also, I think, some willingness to have it presented at the global forum, quite simply because it's the ideal, obviously, occasion to demonstrate all the great work that's been done on this particular subject. So, as I say, what the OECD have done is, if I say, these are some kind of design concepts, which we would suggest. There's obviously no obligation. The OECD would suggest that countries around the world thinking of introducing digital reporting requirements take into account, such that these systems are comparable, are similar in structure and shape and format for businesses, in particular, operating on a global basis. So whilst the report was adopted finally by the Working Party 9, which is the one on consumption taxes at the OECD, back in July, and it has now been approved by the Committee on Fiscal Affairs. It's not been submitted; it's now been approved by the committee. But I say, I don't know exactly when it's going to be finally published. But it's a great piece of work, as I say, because it reflects all the hard work that's gone into discussion on this. To ensure that the global level we can try and think about systems to make life easier for business administrations, rather than, of course, being confronted with potentially 176 different systems on a worldwide basis. Rose, any kind of final thoughts?
Yeah, I mean, it is a huge change, I think, here in the EU, and certainly it will be in the UK. I can say that for certainty. But I think from a business perspective, the advantages, I guess, will be that if it means that they get their payments sooner, that will be a big thing for them, because certainly in the UK, we often find, and it's the bigger businesses that hold on to the payments longer when they're paying smaller businesses. If it stops that from happening, then I think there is, more chance that businesses will be able to be more real-time funded, if you like. But I think one of the sort of cautionary notes, I think I would say, is that if countries make it too difficult for someone to do something, it will mean that you have to drag them to it physically, kicking and screaming, as we say in the UK. And some of them will try and find ways around it, or may just say, I'm not going to deal with X, Y, or Z because it's just too complicated. And looking at it from a UK perspective, we're going to have the same sort of issue with people who don't need to be registered, saying, well, what's the benefit to me? So we will have very much the same sort of thing. So it is the way of progress. There is also the issue that I think that certainly was discussed at the Bangkok conference that I went to, is about sustainability, because anything that is data driven uses a lot of resources and also needs a lot of space for the data centers and things. So there is the sustainability side of it as well to consider, but it is the way, I think, of the world at the moment.
Yeah, thanks, Ruth. So, I think the message here is kind of watch this space. There's a lot going on. I mentioned the Commission at its levels produced this strategy document, which sets out a roadmap, with very kind of detailed steps as to what needs to be done to get everything in place at the appropriate time between now and 2030, for the pillar one, but also for the other pillars as well. So, we do these webinars. We also, as RK knows, we run webinars through the International VAT Association. So anybody who would like to kind of follow what's going on, be very, very welcome to join those webinars. So we can keep you up to date, if you like, as what's happening, as it does. It is happening, or changing very, very quickly. Which takes us on to Q&A. Do we have any questions? Well, we have our poll results in the Q&A.
Yeah, I've just put that one in.
Well, if that's always a good sign, I think, if there aren't any Q&A, which just means that explanations and presentations are so clear that no questions need to be asked at the end. So perhaps can we hand back to RK for some closing remarks? RK, closing thoughts? Ah, he's gone.
I can't see him in the room.
If anybody has any questions they would like to ask
Thank
us
you.
in particular about
Thank you very much
please.
thank you very much for delivering such an insightful and engaging session during our webinar. Your expertise and international perspective added great value to the discussion, and our participants truly appreciate your time and effort. We are grateful for your contribution and look forward to the possibility of collaborating with you again in the future. Thank you, sir, and thank you, ma'am.
Thank
Yeah,
you.
thank you. Thanks very much for inviting us again. And as I say, you have our contact details if you've got any particular questions you'd like to ask. So thanks again, everybody.
Thank you.
Thank you. Thank you.
Thank you. Thank you so much.
Thank you. Bye.
Bye.